My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey gang, welcome back. We've got another amazing guest, Mr. Jack Cohen, zooming in from beautiful Aspen, Colorado. And Jack knows a few things about commercial real estate. In fact, I believe Jack's been in business and in and around commercial real estate for something like 44 years and counting. And these days, he's the director at ArrowMark Partners, which we're going to find out about. We'll also find out about a very cool sounding company today, Dark Knight Ventures. Sounds very Batmanish. So, Jack, welcome to the show. Great to have you.
Dave, thank you. I'm excited to be here. I'm excited to wherever the conversation might go.
Well, we have no idea yet until we jump into it. That's the fun of this. It's purely as we go. So, Jack, give us a little snapshot, if you would, just like the 60-second version, if you can, of your commercial real estate background. It's pretty impressive. Hard to boil that down into a minute or two, but give it a good try.
So, for the last 44 years, I have been in the commercial real estate capital markets. For the lion's share of that period of time, I have been a financial intermediary. The industry would have called us a mortgage banker. So I was a broker of debt and equity. I did some consulting and built a large loan servicing platform representing primarily insurance companies. But in the 80s and 90s, when the street became a thing, I started originating to them. For the last 8 or 10 years, I've been a hired gun for various lenders, a mortgage REIT, a small balance lender, and now ArrowMark Partners. ArrowMark Partners, basically, the parent is a large fixed income asset manager based in Denver and Cherry Creek, about $24 billion assets under management. An industry colleague of mine in 2019 came over to start a debt platform there. And we have a dozen or so life company separately managed account where we make first mortgages for those life companies and manage those investments. We also have raised a fund to provide capital to sponsors in a kind of a dequity kind of way. Preferred equity, co-GP, kind of where we're more aligned with the sponsor. So the day job is basically financing what I would call entrepreneurial users of capital. Dave, I found early in my career that I think I'm too arrogant to play with the institution. I just like crazy entrepreneurs. And so the crazy entrepreneurs kind of, are in let's just call it $5 to $40 million capitalization space. I just have always found that fun, and that's really where I've spent my entire career, either as an intermediary, an investor, or a lender.
So when you talk about entrepreneurs, what kind of businesses or ventures are you guys primarily financing? I thought it was primarily real estate. Is that correct? Or?
It's all commercial real estate.
Okay.
It's all commercial real estate. And it's a really good question because I learned the answer to this the hard way by, like all of us, assuming we actually know what we're talking about. When I started when I started running somebody else's small balance lending platform, the entrepreneur was just a local entrepreneur, dry cleaner, the local plumber who wanted to own his building. And although it was a really lucrative business, I think I concluded that where I wanted to spend my time and where we spend our time at ArrowMark is our customers are entrepreneurs 100% of the time in the commercial real estate business, represented 100% of the time by an intermediary who is 100% of the time in the business. No part-timers, no hobbyists. These are people that have magnificent net worth and have great stories in their own right. but they're entrepreneurs and their business is creating all of these different assets, which you could argue every one of those properties is a business.
Oh,
right?
definitely. Yeah. So speaking of properties, Jack, commercial real estate, that's pretty broad. Do you guys kind of niche it down? What's kind of your sweet spot?
We joke the four food groups: office, industrial, retail, and multifamily. But I like parking garages. We do hotels, although I'm not fond of them. We have done data centers. I'm not a fan. But I would define it as income producing real estate as opposed to somebody's home. In self storage is something new to me, but the platform's done a lot of self storage. And it's kind of funny because when I grew up in the business, I cut my teeth doing industrial loans around O'Hare Airport. So you may not realize this, but O'Hare Airport, Chicago's major airport, was built in 1957. And right after it opened up, all these little communities sprung up that developers built small industrial buildings. And I used to call them single family plants because they were the skin to somebody's industrial and manufacturing business. And I would kind of go down the street, knock on the door, talk to the CFO, and see if I could finance their property. So it's income producing real estate kind of all over. But in the beginning, my nose was up on self storage. I liked industrial. It was simple. I made a mistake. Self storage is a cool apple clip.
Nice, nice. Well, that is fascinating, Jack. Now, one thing that really kind of piqued my interest with some of the information you sent in ahead of time prior to the interview was, a lot of people, especially in multifamily real estate these days, have got their knickers in a knot. They're freaking out. The interest rates have gone a lot higher than they think they should be, and prices have kind of come down, and there was all this frenzy. And I think you said something along the lines, what's happening now is nothing new. And 44 years in the industry, you've been through a few cycles, that's for sure. And you also said that we need the has-beens and the wannabes flushed out of the system so that those who can create value do. And the industry lost its way by confusing price with value. Can we unpack that a little bit? Because there's a lot in that statement.
So yes. So when I came in the business in 1981, long-term interest rates were 17%. Prime was 21, and I was stuck converting an apartment building to condos in Rockford, Illinois, with unemployment at 22%.
Wow.
So my first lesson in real estate is that all real estate makes money. The only question is who owns it at the time. And I think that people kind of lost their way. Over the last 10 or 15 years, a monkey could make money because all you had to do was tie up the property. And during the time you were hanging around the hoop, interest rates went down and cap rates went down. And even if your NOI went down, you created value went up. You sold it for profit, and then you went and told your buddies that you're a masters of the universe.
Yeah.
The reality is, we talked about it a minute ago, is that each one of these assets are businesses. They have customers. They have a balance sheet. The asset is the building, and the liability is the loan, and equity is invested in the transaction. And if you think about that, I don't care how good you really are. Now, I would rather be lucky than smart any day, but if you're talking about being good, it takes time to create value. And this idea that I'm going to get a short-term floating rate construction loan for 18 months and that I'm going to be done in 20 months, and it's fantasy, pure fantasy. If somebody has a real sponsorship, a real plan for their asset, how they're going to create value over time, then somebody can finance that. They can put equity in the deal. If they got positive leverage, equity's getting an enhanced cash flow. And as income goes up, value goes up. And at the same time, your cash flow is paying down debt service, amortization. Whoa, not interest only, amortization. The eighth wonder of the world is refinancing a loan that has been amortized, because you can get all that money back tax-free. But it takes time, and it takes time to create value. So I think people have to hold assets long term. So I made the comment, this is not a bad period of time. If you think about the multifamily people, and I'm talking about many of your interviews that you've run podcasts with, these are people who are qualified, who have good assets in good marketplaces. What they need is just more time.
Yeah.
Right? The other thing I've learned about the business is that you can't legislate against greed or stupidity. And so as rates came down, people wanted floating rate. As cap rates went down, people thought they were better at what they really were good at. But if you go back to the 1990s, Roger Lowenstein wrote a book called When Genius Fails. It was the first, you'll remember it was the first hedge fund that failed. And the punchline there was you had to match your assets with your liabilities in terms of duration. We have a long-dated asset that by and large has fixed income increments. We need to finance it fixed rate, long dated. And so my view is we're trying at Aeromark to find the good sponsors who are upside down, trying to help them with maybe a thick piece of preferred equity, refinance the capital stack to give them more time to earn their way out. Now, if you're an idiot and you have a bad market or a bad asset, capitalism means you should be washed out, learn your lesson, and then come back having learned that lesson.
A little smart,
right?
Yeah, a whole lot smarter.
Right. But better we teach our teenagers, right? You want them to make mistakes, just ones that they survived.
Yeah.
So that's what I mean. And I think, look, if you have an asset that you want to sell, the value is what I'll pay for it. But if I'm a buyer of your asset, I have to have an opinion about what the intrinsic value of the property is. If all I'm doing is buying it based on what I can afford, then you're just like my wife buying two purses because one was on sale. Like that wasn't a value purchase, that was a price purchase. And I think we have to get back to creating value, identifying, assessing, mitigating, and pricing risk, and staying in our deals longer.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So, based on your decades of experience, Jack, if you're talking to multifamily investors or LPs who are looking at potentially getting into deals these days, what does long-term mean to you? Like what should be a realistic expectation people should have, like minimum time frame to really do a good multifamily?
Well, I'll give you two answers. The tactical answer is really, I would say 7 to 10 years.
Yeah.
It's interesting. I got caught in 2016, 17, the VC play of fintech and prop tech shit. I know a lot about real estate, and I got a good IQ. I'm going to do this fintech thing. I'm in all these deals for like 10 years. I was an idiot. Right? I thought this was a get-rich-quick scheme, right? It takes time to create value, and I think 5, 7, 10 years is a better answer than a 3-1-1 bridge loan. But I'll tell you this. If you look, and I mean really look, at the New York families, the San Francisco families, the Chicago families who are really, really real estate rich, I mean 9 and 10 figure rich, all of it started because they bought real estate and held on to it for decades. They financed it multiple times. They got the benefit of amortization. They took money out tax-free. They bought another building and repeated it. So I just think I blame Wall Street. In the early 90s, it was financial engineering, and the financial engineering brought a lot of capital to the space, so that's good to the home team. But it got away from creating brick and mortar value. It focused on financial engineering. And things are so easy, our muscles atrophied, right? Instead of building a relationship, here's one thing your listeners are going to learn the hard way. In the olden days, people found banks and insurance companies and built relationships with their lender because, God forbid, interest rates spike or something goes on and they have a problem, they need to work the loan out.
Right.
But when everyone started shopping, instead of going to their local bank, they'd hire a broker to get them 57 bids and they'd take the lowest guy for a point. That guy who has your loan now has you. You got a problem on your asset, you are going to bleed mightily because there is no relationship there. And by taking advantage, not building relationships, not building value, I think we kind of got soft. We forgot how to meet a girl in a bar because we go to an app.
Online. Yeah, exactly.
Right. And so a lot of this is really very, very, similar, and I'm poking fun at it, but I really think that there's an opportunity for people to decide that this is something they want to do or not, that this is their passion and they know how to create value, and now they'll get a reset. It's not their fault that they bought. If you really think about this, there's a basis question, right? We used to talk about basis about, well, how cheap was the land or what's your price per square foot? But now basis is when you went to the market for financing, what were treasuries, right? So if in the States, if you own a home, if you're in your, let's say 40s and you own a home with a 2.5% mortgage, two things are real. One, you are not selling your home because you don't want to give up that 2.5% mortgage because you can't replace it.
Transfer, yeah.
And two, if you do go look for another home and rates are at 6.5%, you're going to have to downsize. You won't be able to buy as big of a home, right? So on the commercial side, we have the same thing. Because the interest rates got so low, we could afford more debt. We bought more real estate. We had less money in it. And now we have to make a decision. Yeah. If we don't like the asset, learn our lesson, go home. You probably borrowed non-recourse and go try something else. But if it's really a good asset, then find somebody to help you refinance it, put some equity in. Maybe you have to take a hope certificate. You have to let them come in and take a priority to you. Oh my God. Go back to my statement about fintech. In the last month, two businesses that were supposedly worth $1 billion last year are going to run out of money. Valuation, 0.
Wow.
So they're asking for capital to come in. And essentially the owners of the business and all the other people with capital in are saying, Dave, if you put $25,000 in first, put your money in to help me, I'm going to give you $50,000 back before I take a dime.
Wow.
Right? That's how they're going to bail out. Watch. That's going to have to happen in real estate. So if you got to pick right. But a lot of people are kind of hanging on, or they're saying, I have no economic value. I'll give the property back. I'll live to fight another day. I have no argument with that. But if you had that one asset, that's a generational asset, you might want to consider somebody coming in, giving them a priority to help you buy time because you believe in this asset, and you will not only make a lot of money, but you'll make relationships. You will be remembered when the marketplace gets hot again, and you will get financing. You will get people banging the doors down for you to provide to people to give you money. but you got to earn it that way.
You got to earn it for sure. Jack, time flies when we're having a great conversation, which we definitely are. Didn't even have a chance to get into talking about your other business, but I'm sure there's going to be some people listening or watching this who would like to connect with you. What's the best way or the best place for them to go?
So I have a personal website. It's darknightventures.net. So for the Batman fans, there is a Batman story I'm happy to share, but it's Dark Knight, like Batman, 2 Ks. Ventures, plural, because I have more than one. .net, because I couldn't get the .com domain. So you can find me there. You can find information about some of the things I'm doing. Hopefully this podcast will be put on it when you release it. And I have kind of an attitude problem blog that I call Jack Chat. And if you're interested in some of my methods through the years, I've been writing this blog for more than 40 years.
Wow. Jack, thanks so much for being on the show. This has been a lot of fun.
Thank you.
All right, everybody, take care, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.